What's really good? What's really good? We're back at it again. So in today's video, we're going to be going over a part 2 of a beginner's guide / course to getting into day trading. Those who are beginners, don't know where they're going, don't know what to do, don't know what they're looking for essentially. And that's what this video is going to be based on. Previous video was going over the trading platforms that you would need, the tools that you actually need, indicators that you actually need, and then just a brief, quick understanding of what you need to be focused on in trading. Now, this video is going to be talking about the reality of trading, expectations of trading, what you can expect going through your trading journey, and then a couple of brief, not brief, but a couple of aspects into strategies and techniques with POI zones and such that you can use essentially when you are starting to trade, when you are starting to take demo trades and practicing and seeing how the market works when it gets to those areas, and et cetera, so you can start getting some screen time, building a better mindset and overall understanding within the market, and get further and further and deeper into your trading journey until you can jump to a live account or funded account and start making some bands. All right, so let's get straight to it. This segment of the video is going to be talking about the reality of day trading. Then I'm going to go to the expectations, what you can expect going deeper to your trading journey, and there's some strategic aspects into Fibonacci and supply and demand zones. So then y'all can leave with some more information. So the reality of day trading, if you're getting into trading, believe you're going to be making money straight off rip after 1 to 3 months within the market, that's just not going to happen. And the reason why so many people believe that is because the people that they see 24/7 within the trading community are a bunch of mainstream traders, big mainstream traders who are all trading gurus who only talk about the money aspect. I guarantee if you look up just day trading, how to day trade, the first handful of videos, matter of fact, if you just scroll down the entire freaking list, it's only going to be those big mainstream traders before you get to the, the minor ones. And I guarantee every single one of those thumbnails is going to be related to making $500 a day, making $1,000 a day, making $10,000 a month, a fast car, a big crib, a stack of money, this, that, and the thing. And that is a false reality of trading. The reason why you constantly see that within the trading community is because it's those big mainstream traders who are selling courses and mentorships have to find a way to get you to actually buy into that bull crap. And guess what's the best way to do that? By selling you a false reality of having all these nice cars and having all these nice cribs and this, that, and the third. But the truth of the reality of day trading is it is very lonely. It can be very boring at times because obviously within trading, you're trying to focus within everything in trading. You're trying to become a better trader, this, that, and the third. You're trying to learn, et cetera, et cetera. And majority of the time you're going to be spending on the charts. You're going to be trying to observe things, learn things. And outside the charts, this is going to be you, the family, working out, this, that, and the third. Do not expect to see a crap ton of money and all these nice cars woo straight off rip, because that's just not how that happens. Me personally, and everyone goes through this, like a month and a half into trading when I first started trading, I thought I had it in the bag because it's not that hard to understand a strategy and just mark out a couple of zones and wait for a rejection and then click buy or sell. It's not that hard to do that. And because of that, I thought I was going to be making money straight off rip. A month and a half in, I got into a live account, and then guess what? Lost a bunch of money. And a lot of people continue to do the same crap because they get brought into this false reality of trading that, hey, you'll be making a crap ton of money as long as you understand support resistance, as long as you understand rejections, as long as you understand this strategy, this strategy, this strategy. You'll be making 500 a day and this, that, and the third. And that's just not the reality, because guess what? Everyone who talks about how this strategy will help you make 500 a day never talk about what you actually need to actually make that 500 a day. You need money. You need, depending on what you're trading, you might even need leverage. You feel what I'm saying? So stop buying into that false reality. Do not expect any of that stuff, because you could have all that stuff, but do not expect to have all that stuff straight off rip within the first couple of months or your first year, whatever. Do not expect to have all those things based on the false reality being sold by others because they have it and you believe that you'll have it. Just because they got it doesn't mean that you'll have it. And just because they got it doesn't mean they got it from the same source, which obviously should be trading. Because think about it. If I'm making $100,000 a day, why on earth do I need to be charging people $10,000 a month to buy my course for some information, which is the exact same information I put out for free on my YouTube channel? That's also for free for thousands of other people who talk about the same crap. What would I look like doing that? What does it look like for them to do that? That is greedy. So stop buying into that false reality, because that's not a true reality that you can expect straight off rip. That's something that you can see later on in your journey, but that's not something that you'll see straight off rip. So the expectations of trading. When can you expect to become profitable, successful, this, that, and the third? You can expect all those things quicker than most if you are able to be self-aware and disciplined from day one. Trading is more than just the charts. It is, I'd say, 90% emotions and like 10% charts, because it's not that crazy to understand a strategy, mark out zones, and just wait for price to retest, react, and then you just click buy or sell. It's not the crazy aspect. It's not the easiest, but it's not that hard of an aspect. That's why when people are spending years in the market with no success, it isn't related to the strategy, it's related to the mental aspect. That's why people say 80+% of trading is mental and the other 20 or less percent is the charts. Now, when it comes to the emotional side of trading, me personally, and I say it 24/7, if you are not doing it with God, it's going to be a lot harder to try to suppress those emotions that you have, because you have no power over that. And the more that you allow those emotions to run your life, is the more the devil is running your life than you are. All right. And it's going to be 10 times harder trying to avoid those emotions, trying to suppress those emotions so you don't make stupid decisions, lose all your money, spend years in the market just like everybody else with no success. It'll be 10 times easier doing it with God than without God. Now that you know about the reality of trading, that those are not the things that you will see off rip, and that you do not need to be believing into that crap, essentially. And then we just went over the expectations. How quickly can you expect to possibly become profitable in this, that, and the third if you do what you need to do from day one? Now we're going to go to some strategic aspects in the trading, going over Fibonacci and supply and demand. So let's say you're in a trade and price is pulling back some, essentially. That's when you would want to, pop the Fibonacci. So let's try and find a good example. Okay, we have the extension here. Beautiful. Okay, this is a beautiful example of using Fibonacci on a lower time frame for in the moment trade. So let's say I came here, I bought into a contract off of this rejection. Okay, we'll say stop loss is here, and my TP is all the way at the 0.27 because we're trading all time highs, meaning there's nothing else above. All right, and then guess what? Price starts pulling back some. It starts consolidating and pulling back. So I'm getting kind of worrisome because I'm thinking, oh crap, this might reverse on me. This is when I would pop a Fibonacci. I would base it on the low point because, as we can see over here, let me move that really quick. Let me move this really quick. We had a push up. It pulled back a little bit, and then it pushed up some more. Therefore, we're going to put on that low point before that overall, minor pullback, you could say. And then we're going to put at that high point before price started retracing again. And as you can see here, price went in between the 38.2, 50% extension level. And every time it went in there, it rejected off of it. You could have caught a minor buy side move here. You could have caught another buy side move here. And then you could have waited for a longer term buy side move off of this strong rejection, pushing price all the way up. So guess what? Based on that Fibonacci, we can set this back up really quick. Based on that Fibonacci, guess what? We were able to confidently hold this trade because price showed that, hey, price is respecting this overall golden zone area, meaning we can expect price to continue upwards. We take it to 0.27, and guess what? It's consolidated to the upside, like I mentioned earlier, meaning that this was a good TP area, essentially. Okay. Now, just like every other strategy and tool, this is not going to work every single time. This will work a handful of times, okay? Because there will be times that, you pop a Fibonacci. So like over here, we'll put it right here. Price starts pulling back. And then guess what? Price just ultimately breaks through it. Might be like, oh, I thought price was supposed to reject off of it and this, down the third. No. Just like any other strategy, it's not going to work every single time. That goes with supply and demand. That goes with support and resistance, fair value gaps, et cetera, et cetera. It's not going to work in your favor every single time. Now, when it comes to Fibonacci and it breaking these zones, you have two, matter of fact, let's go back. You got two ways you can use Fibonacci, which is price respects the golden zones and you take a continuation off of that, or price breaks through it, ultimately closing below this 61.8% extension level, or at least this 78.6% extension level minimum, or maximum. And from that point, you could look to take put options or sell side contracts or sell side positions, because if price breaks this, just let you know, chances are we're going to be going down to the sell side. The same way if price respects the golden zones, we can expect price to, in this case, continue back to the upside and vice versa. Okay. Which then, here, okay, we had our point here. Price started pulling back at that point. Price started respecting within the 38.2 area before continuing even further down. You feel what I'm saying? So when it comes to Fibonacci, because you can place Fibonacci either way. You can place it to the sell side, you can place it to the buy side. If you're going to place it to the sell side, you're going to place the 100% area to the top point, and then you're going to place the 0% area to the low point. The lowest point price went before it started pulling back. Guess what? Price pulled back within this area before it started pushing down even more. And guess what? It went exactly to the 27% extension level before pushing all the way back up. Talk about a beautiful trade, a perfect entry. I said earlier, when it comes to the sell side, you mark it at that low point of that overall retracement. After it had an overall extension, you place it at the high point, like right there. Guess what? Price went into it. Matter of fact, you could have even waited for that before getting into the sell side, which would have been a better position if you didn't just get in immediately after price closed below the 78.6. Would be wait for price to come back within there, reject off of that. And once you start getting sell side confirmation, that's when you can look to get into sell side positions, like right around down there. Stop loss here. Boom, boom, boom. Matter of fact, price inverse to fair value gap. I probably would have waited till the inverse fair value gap, which I'll have another video on that. And then guess what? Because based on Fibonacci, we can expect it to go to that 27% extension level. And boom, price went straight to it. Guess what? Stop loss break even. Guess what? Stop loss break even. Guess what? Stop loss break even again. An absolute perfect trade. Beautiful trade. All right. Now, again, Fibonacci is going to do this every single time. It's not going to work every single time, but it's something you can use as an extra confluence. So, like with fair value gaps, the reason why I don't like trading off fair value gaps is because sometimes it doesn't work a lot of the time. Same with Fibonacci. Therefore, I use it as an extra confluence if prices starting to reject and react in a certain area that I see no other POI zones. All right. And that's essentially going to be Fibonacci. Fibonacci is a tool based on statistic areas and analytics that price should, if it's going to pull back, it should pull back to the golden zones and it should react off the golden zones. And after that, as long as we don't close below the 61.8% extension level, we can expect price to continue pushing upwards in a continuation. Okay. And then again, when it comes to the buy side, you make sure that 100% extension level is down below. And then you make sure the 0% is at the high point before the overall retracement. And then vice versa when it comes to the sell side, you want to make sure that you have the 100% at the top point before price starts pushing down to the sell side. So better yet, we'll put it again. So again, over here, put it at that high point before price started going down to the sell side. Put this at the low point before price started pulling back. Wait for price to react. That's when you get into sell side positions. Okay. All right. Now going into supply and demand. Okay. Supply and demand are zones, POI zones that are based on impulsive candles. Okay. So the same places that you can find fair value gaps, occasionally you will also find a supply and demand zone because both of them are based on an imbalance. Now, if you're a beginner, you might be like, what's an imbalance? An imbalance is just a really big, gigantic candle. You see all these minor candles and then this big old bullish candle right here, the purple one. Yeah, that is an impulsive candle. Price for it to move this vigorously to the buy side, there has to be tons of buyers and maybe even some form of manipulation. And guess what? We had a candle right here, which ended up being significantly smaller than that candle, which is usually the buy demand zones that work the best. And the best ones that you want to mark out are not the big impulsive candles like here that have a bigger candle previously or the same size candle previously. You usually want to mark out the demand zones that have a, like a smaller candle or like a very low momentum candle before the big move. And then guess what? All you do is you just mark out the high point, whether that's on the wicks or the body, and then the low point of the previous candle, and then all you do is wait for price to come back, retest, and then reject off of it. In this case, price came in, it rejected off of it immediately, started pushing to the buy side. If you were feeling ballsy, you could have entered into buy positions. Guess what? You could have took it all the way up there. All right. Or if you want to be more safe, guess what? We have another fair value gap right here, just like when we had that sell side example over here when price inverse this one right over there. And then guess what? Once we inverse that, we retested and rejected again. We could have gone to buy side positions, took it all the way up. Okay. Oh, where do I take the position? I don't know where to take the position. Guess what? Fibonacci. Boom. Popped it. Rejected off the 50% extension level. Inverse the fair value gap. Rejected off the inverse fair value gap. Take it to the buy side. Take it to the 27% extension level. If you didn't get in on the position off rip, you could have got in straight off the inverse and the retest. Boom. Stop loss there. TP at that 27%, or maybe a little bit steeper if you're feeling ballsy, you feel what I'm saying? And boom, W trade, just like that. See what I'm saying? This is me implementing the Fibonacci tool with the supply and demand zone, okay? Now, a demand zone, okay, is going to be on the buy side right here. When price is pushing bullish and it forms a demand zone, when price is pushing bullish and shows you an impulsive candle from the buy side, this is what's going to be called a demand zone. This is a big bullish candle. We're marking out the previous candle. That is your demand zone. And then when it comes to the sell side, for example, like right here, this is going to be called a supply zone because you got sellers at the top and buyers at the bottom. Okay. Supply and demand. People with the supply are trying to sell the product, and people with the demand are trying to buy all the product. Okay. Or people with the demand have tons of people trying to buy the product, while people with the supply are trying the best to sell all of their product. Okay. Now you might be like, why didn't supply work over here? Because just like Fibonacci, just like support and resistance, just like gaps for value gaps, they are not going to work every single time because price only cares about imbalance and liquidity. It does not care about supply demand or this, that, and the third. Okay. And yeah, so a demand zone is going to be like here, bullish candle, mark out the previous candle, make sure it's big and impulsive. And then a supply zone, if I can find a good example, a supply zone would be essentially similar to this. Big impulsive candle, you just mark out the previous candle. So just like a demand zone, but to the sell side. Okay. So we got a big bearish candle, mark out the previous candle. Price, technically speaking, they're respected. So you could have gotten to put options at that point, or sell side positions. You could have took it all the way to the fair value gap. That would have been like a short, nice trade. And yeah, you feel what I'm saying? But yeah, so that's going to be like supply and demand. Really, demand zones, think about it like this. Demand, when there's high demand, there are tons of buyers, which is why when price taps into these areas, there are strong rejections and price pushes up vigorously like we see here. And then sell side, supply zones, guess what? People with all the supply are trying to sell all of their product. They're trying to sell, 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 sell. There are going to be tons of sellers trying to sell all the supply to the people who are in need of all the demand. You will see tons of sell side pressure from these areas. Okay. How to use Fibonacci. Again, marking at the high points. Marking at the low points or the high points of an overall continuation, and then marking the last point at the overall retracement. Again, this is a continuation. This is a pullback, or this is a run, and this is a pullback or a retracement. You want to mark it at the low point when price was just running. You want to mark it at the high point where price starts pulling back. When price gets into those golden zones, if it gets into those golden zones, that's when you can look to buy positions to whichever direction is the continuation, unless price breaks and closes below the 61.8 and the 78.2% extension, 78.6% extension level. And the supply and demand are marked off of impulsive candles. Impulsive candles are big drastic candles like you see here. Therefore, you mark the previous candle by its high point and its low point. High point, low point, and then you just wait for price to tap into it, reject like it did here, and then that's when you look to get in positions based on multiple other confluences, not just price rejecting off of a POI zone. So in this case, we have buy side structure. We can expect a continuation of the buy side period. On top of that, we inverse the fair value gap. On top of that, price respective Fibonacci. That's 3 different confluences. On top of the buy side pressure, we are taking it to the buy side. Simple as that. And yeah, so that's the reality of day trading overall. Do not believe this false bull crap that you see just by mainstream traders. Majority of them are fake gurus who try to present that false reality to sell you something fake so then you can spend thousands of dollars monthly on their courses. Therefore, you can pay them, which is the actual money that they're making, not really off of trading, majority of them. And guess what? You believe that you'll be making all that money off rip after spending thousands of dollars monthly on their course. It's not true. Do not buy into that bull crap. And then the expectations of trading, what you can expect going into your journey emotionally, essentially. And yeah, you feel what I'm saying? Emotionally, when it comes to profitability, et cetera, et cetera. And some brief aspects into supply, demand, and Fibonacci. If I did explain those a bit too quick, I apologize. But guess what? I have videos in my catalog, essentially. Just previous videos I've recorded over however long I have this YouTube channel up. So if that was too brief, go watch my previous video on supply and demand and my previous videos on Fibonacci, which I'll probably have a reboot on that fully soon. And yeah, and I'm just trying to help some people out. Hope it's helpful. God bless y'all, and I will see y'all next time.